All right, like I said, so in chapter 12, we'll be covering the adjusting process, and we'll be walking through that. In here, what we have is we're going to describe the nature of the adjusting process, what it basically does. Basically, what it is at the end of the chapter, at the end of the period, we're going to have to adjust a few things. And we'll talk about what those adjusting things are. Sometimes that can be supplies, unearned revenues, those type of things. We'll take a look at all of those here. And then we're going to journalize the entries for the accounts requiring adjustments, so we'll journalize those, and then summarize this adjustment process there. And then prepare the adjusted trial balance, we'll finish up and we'll describe it. And just basically take a quick view of what a vertical analysis is of a company. Some of the things that you would take a look at more in a managerial class, but we'll also take a look at it here and what it means to us in the financial aspect of that too. All right. So I'll let you read that, the thoughts there, the accounting period concept. And they must match. We talked about that, I believe in chapter 1 we discussed that, where things must match. So anything that we have for revenue should match the expenses there. Some companies do try to pay all the expenses up front to kind of lower that income. But what you really want to do here is they need to match. So that way you can see, have a fair view of what the company is really doing, how it's moving forward. So here, under the accrual basis of accounting, revenues are reported on the income statement in the period which they are earned. So remember that. So under the accrual basis, that's why we use the accrual basis, because it gives us a better idea of what's really happening. Because I could do a job, let's say I'm a landscaper, and I don't get paid 30 days from now, so I show no income for the first month. Well, I've done a lot of work. They owe me money. So therefore, the accrual process says, well, you earn it there, so now we put it on your income statement there. You've earned that. It just goes to your accounts receivable. They owe you that money. Questions on how that works? Okay, so moving on here, the revenue recognition concept here, the accounting concept supporting the revenues, reporting of revenues when they are earned regardless of when the cash is received is that. What I was just basically talking about there. And slow me down if I'm going too quick, just let me know. All right, the accounting concept supporting reporting revenues and related expenses is the same as the matching concept, which we kind of already talked about, the matching concept and the matching principle there. So just remember those revenues must match those expenses. All right. Now the cash basis of accounting is a little different. Basically when we receive cash, just think of it that way. So going back to that landscaping business, I wouldn't count that revenue until I received that cash that following month, even though I did the work. So that's when I would record the revenues. I may have paid the expenses way ahead of time, right? Because I had to buy maybe sod or whatever it is that I did. So that would show that I didn't make any money in this month. I lost a lot of money probably, and then I show I'm making a lot of money in this month when I actually did all the work in this month here. So it kind of doesn't really reflect that. Now, what would you use a cash basis accounting for? Well, some small businesses do. They're basically cash based. You're not going to have any of that. Somebody walks in and buys something from you, and everything's cash, and your small cart maybe, or something like that. You may use the cash basis because it's really simple and you're not dealing with anything else. So on an accrual basis, you may need to update some of those accounts because things change. So we'll take a look at this. These are some of the following reasons here. So some expenses are not recorded daily, like our supplies. We buy a bunch of supplies, and then all of a sudden, we find out we've used a lot of the supplies. So at the end of the month is when we figure out, well, how much supplies we have left. So then we have to make those adjustments to those supplies. And so that's where you'll have some of that. And then some revenues and expenses are incurred at times passes rather than at separate transactions. Again, those supplies things. We're not looking every day to see how much supplies we've used. Some revenues and expenses may be unrecorded. So we may not record some of those things there. We'll talk a little bit about that. Because sometimes, like I said, with the landscaping business, somebody may have paid me in advance before I do any work. So they may pay me 50% of it, let's say, and I'm going to do this whole landscaping project, and they pay me $10,000. They it's going to be a $20,000 project. Well, I haven't earned that yet, because I haven't done any work yet. So therefore, that's an unearned revenue. And we'll talk a little bit about what that means. And we did a little bit in chapter 2. We showed it as that's a liability because I have not earned that yet. And so now we'll move forward and say we have earned some of that. Now I have to make that adjustment. So that's what we'll be looking at here. All right, so the analysis and updating of the accounts at the end of the period before the financial statements are prepared are published adjusting process. And that's what we'll be discussing pretty much throughout this chapter. Right. And the journal entries that bring the accounts up to date to the end of the accounting period are the adjusting entries. So that's what we're going to be doing into each individual account that needs to be done. So there's not a lot of accounts, so don't worry, don't stress out. We got to adjust all these accounts. There's just a certain amount that we have. There's certain ones that we have to. We'll take a look at all the different ones, especially towards the end of the chapter as I go through it here. Now, something that has the prepaid expenses. Those are where we'll have to make some adjustments. So let's start with that. So the prepaid expenses is something like insurance. So if we have $2,400 of insurance we paid for a year, well, after 1 month, we've used $200 worth because I divided that by 12. So I've used $200 worth, so therefore I have to expense out $200. So I have the insurance expense as a debit, and then I'll have my prepaid expense as a credit because I'm going to take away from that prepaid expense. So that asset now goes down by 200, and my expenses go up by 200. Does that make sense? How I do this? So I'll write it up here real quick so you can see it. What I just talked about there. So I was saying that they used $200 of it. So I have insurance expense here, and then prepaid insurance. I'm just going to call it this: the 200 and then 200. So I have decreased my. So in that count now, I'll have $220, and my insurance expense went to 200. All right, and this is kind of how it looks here. Now they have it as, so what we did is pay cash for that prepaid expense. We paid cash for that in this transaction here. So we have cash and we have a prepaid expense. So this is the first thing that happens here. So we had, this is before this happened. We bought that insurance for $2,400. We paid insurance there and then cash here. And again, it only affected the asset side. We traded one asset for another. Again, reason is because I can turn that insurance back into them and say, we're not going to use it. Give me back my money, and I'm with a different company or whatever it may be. So that's still an asset to me. All right. So the next thing is what we have here. As you can see here, I decrease the asset by crediting it. That prepaid expense, which is insurance. And then I increase my insurance expense by 200. So that's what I've done here on the board. Does that make sense? Pretty good so far? Right. Now, other revenues is similar to what I was just saying a little bit earlier. Something like a landscaping business and something similar to that. So, is advance receipt of future revenue. So we're getting it early before we have done anything to earn it. And they're recorded as a liability. Remember that, because we owe it to them. Because if I don't do that landscaping job, that $10,000, I got to give it back because I haven't done anything towards it. So that's why we list it as a liability. So in here, you'll see revenues. We're going to credit unearned revenues, and then cash. I'm just going to use that example I said, $10,000. Then unearned revenue. And remember, this is a liability. And I have the cash in there. All right. And then when I do make the money, when I do the job, so I do that half of the job at the end of the month. So then what happens is now I debit unearned revenue. So if it's a credit, I debit it, takes it to 0, right? So I don't have any more of that. And then I credit my revenues. And that goes up, so now my sales and revenues go up. So if you look at it that way, it was really my cash and my revenues. I eliminated the unearned revenues portion of that. And so that's typically what you would have anyways, right? If it was just a normal transaction that happens.
But it would still be just the 10,000.
Yes. So yeah, you still have to have the 10,000 of unearned revenue. You debit, get rid of that, and you have the revenues of 10,000. Now, if I did another month, same thing. I'm just making an example here. The revenues would go up and be 10,000. Let's say the last one, the typically we'll play maybe half at the beginning and half at the end. So then at the end of the next one, I would actually earn it anyways. So there's no unearned there as a portion of that.
So
Yes.
you credit unearned revenue
Uh-huh.
and
No, you'll debit it,
debit?
and then you'll credit revenues. So your revenues account, so like right here what they have here. So that's what you would do. So now, typically when you have a transaction like that, something like that's happened, it would be cash, you get in for it. And my revenues go up because that's my income statement, and that's my credits that I will have. And that's typically what had happened. The difference is that we threw in the unearned revenue, we brought it in and we eliminated it because it was paid, and we've done the work to deserve it. All right, next is accrued revenues, or unrecorded revenues that have been earned for which the cash has not yet been received. So we've done stuff, but we haven't received the cash for it. And basically that's what it comes down to. So I did all the work, but I just haven't been paid for it. And so in here, there's no entries that's been recorded here as that yet. Now, sometimes if you bill them for it, it may go to your accounts receivable, and then that's revenues there. But accrued revenues, we're not, as at this point, we're not going to show that in there at all yet. And again, this is how they're showing it right here. So at the end of the period, they may have a receivable. When they decide to bill everybody at once, you have a receivable, so I would say that's accounts receivable, and then you have revenue. And the reason why they don't have receivable, what it is because it could be the company's name receivable, Jones receivable, or whatever. Because as you see, as we move in farther into the class, it's just not called accounts receivable. There's lots of accounts under receivable. And it's the same thing with payable. We owe lots of different bills in our company, in different places. And we're looking at a really high level here. So question on how this works right now. Now, once we get paid for that, then we're gonna credit receivables because we debited it originally, right? And then we get the cash in for that, and we debit that. So debit and credit. So then we remove the receivable once we get paid for it, if they pay us the whole amount. We hope that they do. So we have accrued expenses or unrecorded expenses that have been incurred and which cash has yet to be paid. So again, here we're not showing anything on this one just yet. But at the end of the month, what we're going to do is we're going to have some of those there. So we may have an expense, and you can see the interest expense, for example, wages payable. We'll get into that in a little bit, and then interest payable and how that all works. And sometimes what happens is because of the timing of when the pay period ends compared to your month. So like this month, I don't remember what day it ends. Actually, it's like Sunday, so that doesn't work out. But in other months, it may end on a Wednesday. We don't pay till Friday. So we have some money we owe for that Monday, Tuesday, and Wednesday. We owe that money to those employees. So we want to actually put that in there that we owe that to them, so that we're accurate on what we owe. But we won't pay till that Friday or whatever our payday is. And so that's where you'll see some of that. We'll get into that a little bit more. All right, so questions on how all that works. There's not a lot of them that we'll do, but there's a few of them that we have to go through and take a look at. And they don't always happen for every company. It just depends on the company and what they do. All right, so the next thing is we're going to journalize the entries for the accounting required adjustments here. So as you can see here, this is an unadjusted trial balance. What it means by unadjusted trial balance, well, we haven't made the adjustments yet. That's simply what it is. So we're basically balancing out, do our debits before our credits. As you can see here, you'll see a mixture of your accounts. You'll see basically your balance sheet added in with your income statement here, which the income statement feeds in the balance sheets. And so this should, and so it should balance. If it doesn't balance, you have to take a look at why doesn't it balance. Take a look at some little things there. So I showed you these before. Basically the accounts, the expanded chart of accounts there, and these are some of the areas where we're going to focus primarily on for this adjustments. As you can see, accumulated depreciation. Why accumulated depreciation? Well, we depreciate once every term or every period or every month. So we depreciate our office equipment over time, just like we depreciate a house or a car and different things like that. So that's what we're going to take a look at there. Then the wages payable, if it falls in that different time frame I was talking about. And then your rent revenue, just depending on, because they may have paid ahead of time. Some people pay. I am fortunate that my tenant paid me for 4 months. yet the other day for the end of the year, which is great. But so that's unearned rent for me, right? I haven't earned that rent and paid way ahead of time. So if they decided to get out, I have to pay some of that rent back to them, wouldn't I? So that's what this is about here. And then we have depreciation expense, which is a part of that. And then you have the insurance expense we talked about. All right, so let's take a look at that prepaid expense. We're going to do an example here. Oh, wait a minute. Yeah. So this is supplies. So what we basically are looking at here is we had this much of supplies, $2,000. At the end, we had $760. So how much do we use? Well, we used $1,240, right? Basically, I'm just subtracting the $760 from the $2,000. So we used $1,240 of it. So that means I have $1,240 in expenses. $1,240 in expenses for supplies. So to do that, that's just what we'll make. This is the transaction that we're going to do. We have a supplies expense. Remember, the expenses are going to be a debit because we're increasing the expenses there. And then our supplies will decrease. By crediting that account, I now bring it down to $760. That account is now having a total of $760 into it. And so these are the references going back to each of those accounts there. And then there's this simple description of what's happening there. So questions on how that works? You guys getting this okay? That's good. All right. I'm not overwhelming you. That's a good thing. All right. And so this is how it kind of goes into their accounts there. As you can see, my balance is $760 right here. And right here, you can see my balance on that has gone up also. Increase, and then we decrease our supplies. So we're increasing the supply expense, but that actually decreases my stockholders' equity. Okay, just be aware of that because it's lowering how much I make because I have more expenses. That's what it kind of gets a little confusing with that. Okay, so let's take a look at prepaid insurance here. So actually, they used the example that I used earlier. So we have $2,400 in that Solutions prepayment insurance. Account represents the December 1st prepayment of 12 months. So we pay prepayment for 12 months. So that means we're going to use basically what I showed you here. We use 1/12 of that. So $200 and $200. Questions on that one since I already kind of went over it? What's that? All right, so I won't go too much detail. But yeah, that's all that happens. So the next month we do the same thing. The same thing. And so you'll see that prepaid insurance continue to drop down, and by the time November hits next year, at the end of November, we're done with it. We can pay it again and do the same thing over again, but that's kind of how it works. So this is what it looks like here. Again, same thing as we happened on the previous one. So this is decreased down to 2,200, and then this went up 200 there. All right. Now, this is basically taking a look here at some omitting, forgetting to do things, and overstating different things that can happen. So as you can see here, we understated our expenses, so our net income is overstated, which kind of affects our stockholders' equity if we overstate that. So if we don't put a lot of these in there, we will overstate a lot of our income. And we don't want to do that. For a couple of reasons. One, you don't want to do that for taxes because you don't want to pay taxes on something that you really didn't make. Two, we want to make sure we're showing how we're doing to those who are looking at our financial statements. So that's the difference. That's what's kind of showing you here is if you forget to do that, this is some of the things that will happen. All right, so unearned revenues, going back to that unearned rent. So they pay basically $360 for 3 months to borrow that land I believe they had or something like that. I can't remember. They were renting out something there. So $360 for 3 months. So it makes down to $120. So basically to figure that out, I'm going to have unearned rent for $120. And the reason I debited that is remember it's a credit balance before because we had $360 in there. And so I'm taking away from that, so now it's only 240, that liability. And then I have rent revenue has gone up on that side too. So I have an increase in my rent revenue. Okay, so far? So this is how I worked, is affected there. My rent revenues went up. I lowered how much I owe, so I still now, my liability is 240 now. So. And if I forget to do that, that's going to be some of the things that can happen there also. So I may understate my self-reverse equity. Okay, accrued revenues. So accrued revenues basically here is Dissolution signed an agreement with this company here on December 15th to provide services at a rate of $20 an hour. As of that, they provide 25 hours of service. The revenues will be added to the January 15th bill. So we want to basically show that we haven't billed them for it, but we've done all this work. So to be accurate about showing the information about our financial statements, we then need to put that in there. So to do that, we have accounts receivable of 500. And then you have fees earned. So we've increased that, and basically what it is 25 hours times 20. That's what we have. And then on January 15th, we will bill them at that point, or whatever we've set it up. I think that was the 15th there. And so we have accounts receivables, that, and then there. The one thing to be aware of, though, too, is they may be 45 days before we collect, depending on what we've set up with them on that. But we want to be accurate in showing what our financial statements and how we're really doing and what's really happening with our company. So that's why that is happening. So as you can see, it increased my accounts receivable and also increased my fees earned. All right. So now, remember I went to that accrued wages, and I kind of gave you an example there. So in here, you'll see some of the different dates. And so the end of the year, it hits right here on a Tuesday. And so instead of, so that means I have a couple days I've got to pay for. I've accrued some wages there. As you can see, looks like it's accrued wages expense for $250 here. And then we have different times when we pay it. So take a look at that. What we have here is that Dissolution pays its employees bi-weekly, so every 2 weeks. During December, Dissolution's paid wages of $950, December 13th, $1,200, and December 27th. And as of the 31st, Solutions owe $250 to employees. So for that Monday and Tuesday, that I was just showing you about. So since we owe that $250, we have an accrued expense there. So that accrued expense is basically your wages expense. So we have $250 there, and then we have wages payable $250. What we do then is at the end of that, we will pay that off. We'll get rid of that wages payable at the end of that, the third, or whatever, the third. And the week, we'll pay that off, that wages payable, and then also we'll have additional wages expense for the first 3 days of that new year. So as you can see here, my wages payable, there's nothing in there, so that's the first transaction in here. Because we usually pay that off every time, because we don't pay our employees, we just do business very long. All right, so both those increase there. Now, this is going to the third, I think it is, or the next pay period. So they had to wait a little longer. That was the 10th. So the 10th here, they have wages expense of this. This is the total wages, or this is the total wages expense. So this is the total pay that we made here. Oops. Yeah. All right. So this is the total pay we have here. This was the portion that we paid for the first 2 days. This is the last 8 days that we paid as a part of that. So that's the total. Questions on how that works? And so by the 10th, we've wiped out that wages payable. That's no longer there anymore. But to accurately reflect all those things, we have to show those things. Otherwise, these types of things happen, and net income is overstated by $250 because we didn't put that expense in there. Because we still owe that money, we never put that expense in there. We should have. And so that's where the problems can come in if you don't do that. Okay, depreciation expense. So what we can depreciate is fixed assets, plant assets, those type of things are physical resources that are used by the business and permanent or have a long life. And so those can be different things from computers to cars to buildings, those type of things. As time passes, a fixed asset loses the ability to provide useful services. So this decreases useful services. Usefulness is called depreciation. So we depreciate those things. And there may be a salvage value. At first, we will not look. I don't believe we look at salvage value at first. We'll talk about that. What that means. Basically, when it's at the end of the time, it still has a value that you can take your car and you still get $1,000 for it or whatever it may be. That's your salvage value. All right. So all fixed assets, now remember that except land. We can't depreciate land because dirt is dirt. So we can't depreciate that and lose the usefulness. Thus, it's had to be depreciated. So I'll let you read through that. So that's just depreciation expense, and that's how we record it. And you'll see a contra asset account, which is called, it doesn't make a lot of sense probably just yet. It's called accumulated depreciation, because that is the way we take and continue moving forward on that. So 5 years from now, we can take a look and go, how much have we depreciated on that house? We depreciated $5,000. That's our accumulated, because it's accumulated over time, depreciation. Depreciation expense is what has happened in that period of time. Okay? So, the fixed asset account, is not decreased when making the related adjustments. We do put that into the accumulated depreciation is increased. So we don't touch what the value was of that. We have a contra asset. Basically what the contra asset means is basically it's taken away from that asset. And as you can see, it is credited. So if we credit an asset, that means we're taking away. That's why it's called a contra asset. We're taking away from that asset. Here's another one to take the demo. Okay. And it's called contra asset. Contra asset accounts. That's how we do it so far. Is it making sense? It's not better than the first couple chapters. All right.
First one was tough.
Yeah, well, it's just all this new stuff. It's hard to figure out. And I liked a couple things about how it goes through it, and I'll kind of go do a refresher a little bit if we need later on. All right, so what we have here is fixed asset accounts. I'm going to give you some examples here. Land obviously doesn't have a contra asset because you cannot depreciate it. You have buildings, so you have accumulated depreciation of buildings. And then this one will say store equipment, accumulated depreciation, store equipment. So you specify what it is then. So that way we can tie what asset it goes to, that contra asset account. And then lastly, office equipment, same thing, depreciation of office equipment. So we know where we're pulling that from. Questions? All right, Net Solutions estimates the depreciation on its office equipment is to be $50 for the month of December. So that means we have accumulated depreciation. We're going to add to that. I don't know what it is previously, but we will add this to it. So we have a depreciation expense and then accumulated depreciation of office equipment. So that credit there takes away from the value of that office equipment by $50. Does that make sense? I'll just take it away. And then we've increased our depreciation expense. So what we've done in effect is lowered our net income, right? Because we have increased the expense, which lowered our net income. All right. And so the equipment was this, $50. So my real value in that, when I'm showing that, is $1,750 is what it really is up there, after I have taken account the depreciation. All right. The difference between the original cost of that was basically what I just said. The office equipment account is called the book value of the asset or net book value. This is computed as shown here. So basically the cost of the asset minus the depreciation. So what I was just talking about there is now $1,750. And that's your book value of that asset. And then the next month it'll be down to $1,700. You continue to drop down until you come to the salvage value or you pick it to whatever, nothing. sometimes you have something that doesn't have a value. And there might be a computer or something like that, because after 5 years, there's not much value to that computer you donated typically, because there's not much left. What's that? It's, yeah, you can appreciate it down to, but it's not totally worth. Accounting wise, it may be, value may be 0. But, the same thing goes for the office equipment there. And so this office equipment, like I said, that's, when it comes to $17.50, that is your value in the office equipment. Any questions how we came up with all that? All right. By not doing that, our net income is a little higher because of that. So by not showing that, we're overestimating my net income by $50, and that means I'm overestimating my what's it called? The orders equities also $50 because of that too. All right, that was objective 2. Questions? Just a couple more. All right, so this is a summary of the adjustments that we're going to make here. We kind of made all of this. So you can see some of the examples that we've done and some of the things that have happened as a part of that. You see the supplies and prepaid insurance, how those all happened, and what the effects are in each of those there. That's in your book. Why don't you take a look at that. This is your unearned revenues, some of the things that have happened there. So we got to make those adjustments because now we've earned some of those revenues. And then we have our accounts receivable, because our accrued revenues we've earned in the work. Then we have accounts receivable here, and then our fees are earned. So we need to put that down. Just kind of reviewing the things that we've already gone over. And then there's our wage and expense because of where it ended up in the week. So we had a couple days there. So we have a wages payable. And then our accumulated depreciation, and how that all works, what it affects. Then you have that contra asset account. So when you hear contra asset, that's basically what it means we're taking away from that asset. So these are all the journal entries that we just did. Every one of the ones we did here. And so there was 6 of them. As you can see, the post references ties all back to the original, to where your accounts we have. All right. Questions? Any of that? I guess again, it's pretty good. So these are the accounts that we had to make adjustments to. As you can see here, this is our account for related depreciation. We increased it, so now my balance is 50. Next month we'll have another 50. Now my balance will be 100, and it will continue to grow. Over here, we adjusted some other ones here. My accounts receivable here went up by $500 because we did that work. So it fed into that. This is my wages payable. We credited that $250 because we owed our employees. And here we have our supplies. We took away some of our supplies that we used, $1,240. They gave me $760 left over. So these are my balances in each of my accounts that I have. So we take those journal entries, move them into their accounts. And continuing forward, there's our depreciation expense there. Went up to $50. And then in here, our prepaid insurance went down to $220. Because we used $200 of it, and then it went up to $200, and it went to $1,800, and so on. And a few more here that we've taken a look at also. So those are the accounts, that the ones that are in blue, the ones that we affected. The ones that are not, we're not affected by some of the things we're doing. All right. Now lastly, what we're going to take a look at here is we're going to prepare an adjusted trial balance. Actually, I think we may have another set of slides. So the purpose of the adjusted trial balance is to verify that debits and credits equal. That's basically what it comes down to. We want to make sure that they equal before we start preparing those financial statements. If they don't equal, then we've got a problem. We've got to take a look at why it doesn't equal. So in here, after all of that, you see that it does equal 43,400, 43,400. So since they both equal, so far so good. And even with all those adjustments in there, everything is okay. All right, lastly, what we'll take a look at here is a vertical analysis. And what basically that is how the company has fared. So we'll take a look at that. So taking a look at the same statement, using a couple different things here. So as you can see, take a look here, we have 2013, 2014. And we're taking a look at different things here. So if I'm a leader of this company, I'm looking at a few things. So let's take a look at this here. So in 2013, my wages expense was 30% of what we made. Now it's 32. All right, so what's happening here? And there could be justifiable reasons for this. Maybe it's because we expect to even make even more money next year, and we're ramping up to make sure we have enough people to be able to do that. And so there may be a justifiable reason for that. But that's something just to be aware of if we're looking as a leader, what's happening with our company here. Our rent expense stayed the same, our utilities expense went up. Maybe that's something we need to take a look at there. But there may be a reason again for that. We have to just see why is that. Just kind of gives us a quick glance at it. One good thing is our supplies expense went down. That's a good positive thing. Then the rest of it's pretty similar there. So there's not too much. The only thing I would really be concerned about is my wage expense. But like I said, if I'm ramping up, getting people there, trained, so that way we can expand even more so, then it's justifiable to be up a little bit higher than that. But those are some things to kind of look at as a leader of a company. So questions on that and how you look at those things? So basically, these are percentages of this. So it's this divided by, I think it shows me on the next part here. Yeah. So basically, I take that 12,500 divided by the 750, and that gives me that. So we're just taking a percentage of my fees earned for sales, or however it may be. And this is another one here for the previous year. We take it to the previous information too. All right, questions? That's chapter 3. All right, let's take a look at a couple problems real quick before we head out to break. Let's start off with PE 3-3A. I'll let you guys get a chance to read that one and get started here. So it's PE 3-3A. So I'll give you a moment to take a look at this one here. So the supplies account has a beginning balance of 1975. It was debited for 4,125 for supplies during the year. So basically we purchased more. And then we're going to journalize the adjusting entry required at the end of the year, assuming the amount of supplies on hand is $1,850. All right. So what we're going to do is we're going to journalize that transaction there. 131. So page 131, PE 3-3A. Now, if you look back in the chapter, you can even look on Exhibit 9, which is on 121. You'll see what you're supposed to do with your adjusting entries there. So remember what we're going to do is we're going to take away from my supplies, and then I'm going to increase my supplies expense. So to do that, we have supplies, expense, and then I have supplies. To figure that out, we'll call it supplies used here. And I had 1975 and 4125. I'm gonna take away what I had at the end, which is 1850. So questions how I got to that point? So I added what I started with to what I purchased, and then took away what I have at the end, because that tells me what I've used. So, I do this in my head. 125, so 4250, maybe? Okay, sounds good to me.
That's what I got too, so.
Okay, all right. So that's how much we use, and that's how I journalize that. And then I would take the date, whatever it told me. I didn't put that on there yet, but be December 31st. I think it's the end of the year, right? So questions how I came up with that one? That's pretty good? Okay. All right, let's do one more. PE 3-10, which is on the next page. Or actually, the following page past that. So it looks at the last things that we looked at here, and I'll put that up so you can take a look at it. I'll give you a moment to take a look at that problem. Yeah, it's also on the board, an example of how that works. I'm going to erase that, okay? I'm just copying this down right now from the book. I'll probably need your help. So I have the calculator on me. And so these are similar to the problems that you'll have in your homework. Now obviously this is going to be 100%, right? So what percentages of this is that? So basically 435 divided by 725? Do you have that?
Yeah, 60%.
60%? Okay. 2%, so that makes us 40%. Did you get this one yet?
Yeah, 58%.
58%? And that would leave this at 42%. All right. Everybody know how we got that? So if I'm looking at this as the leader of the company, I'm starting to think, okay, wait a minute, this is not a good trend. You see, so that's part of the question. The second part of the question asks is this a favorable trend or unfavorable? This is not a good trend. If my expenses are increasing at a higher rate than my fees earned, that's not a good thing. Because I went from 58% operating expense to now 60. That's not favorable. We want to go the other way. We want to decrease that. That would increasing our operating income. So as you can see, our operating income actually value-wise went up, but percentage-wise it went down as a portion of what we pay. So that's some of the things I would look at now if I'm the leader of the company going, all right, what happened here? Why did our operating expenses go up? And there may be a justifiable reason for that. Like I said, sometimes there are reasons for that. But we want to look at those things when we see some things like this. Why did this happen? Like I said, there could be many different reasons why it happened. We bought a new machine that's taken some lot more, cost us a lot more to run, But in the long run, it's gonna help us because we can do a lot more with that machine. You know, there may be some reasons that, such as that, and there may be some other reasons, but we wanna look at why has this happened. So questions? How that breaks down? Any questions at all? All right, you ready for dinner break?
Sure.
Sure.